Okay, I think lots to unpack there, but what gives you the confidence that this index could double? And by the way, let me press you, by when?
Well, timing is always a big question. It's a million-dollar question. I think there's definitely, at least in the near term, 10 to 15% upside in Chinese equities. Now, a few conditions have to be met. I think I have to qualify that, right? A few conditions have to be met. Now, first and foremost, the announcements thus far by the Chinese authorities, they are significant, undoubtedly. And more importantly, the Chinese administration is aware that more is needed to be sufficient in achieving its objectives of arresting the overall economic decline and achieving overall growth targets in coming years. So this brings us to the importance of quantum and speed. And I'm really echoing a lot of the analysts and that you've talked to. So quantum-wise, headline figures are important. And that's why all eyes are now on the Ministry of Finance briefing on Saturday and the Bloomberg survey showing around 2 trillion yuan that is expected to be announced. Now, I would also, I think, argue that actually the Ministry of Finance will be able to make some announcements without the MPC's approval. So I think that also sets up. And it has done that in the past. I think we saw that during the pandemic in March 2020, when the MOF actually announced some special measures that that goes without the MPC's approval. And as you mentioned, right, there is so much that hasn't been spent yet. So that brings us to the quantum, the headline number is important. And, as long as these measures are supportive of domestic consumption and confidence in the forms of cash vouchers and subsidies, this will help to arrest some of that concerns. Now, this brings us to speed. So speed-wise, we're seeing some evidences that authorities are ready to step up in terms of putting plans into actions. And that's what, I think if you look at the last 5 mega rallies in Chinese equities, 3 of them have been policy-driven. And so the speed in terms of communications, in terms of announcements, so even if the MOF disappoints this time, it is then really up to the NPC at the end of this month. And the continuation of that communications, that plans, actions are coordinated, are concerted, that will give us a lot of reasons to actually look at China as a very interesting value proposition.
Christy, I get your point. Others on the other side that have expressed skepticism, right? They're starting to flag valuations are one thing. That we pretty much, after this explosive rally, already are at normal levels. We've normalized in terms of valuations. So maybe it's not as cheap as it was maybe a few weeks ago. And then again, this whole prospect of we've been here before, we've been burned before so many times that you're still not seeing long-only funds really convincingly take part in this market. It's hard to chase these outside gains. What's the counter argument to that?
Well, of course, cheap can be cheaper. And over the last few years, that has always been the justification that, valuation is probably the only reason why anyone should be investing in China. And that has led to a lot of hesitation. And I do see that, even value investors, they've been looking to justify that low multiples in China over the last few years with something that is more optimistic and prospects of a turnaround. So now they can actually find it in the policy pivot. So I think that is the big difference here.
Christy, just to also get your thoughts on this too. I mean, so you mentioned, well, we've had 5 mega rallies before, 3 of which have been stimulus driven. Let me play the devil's advocate here. And again, I might be accused of being a China bear, which I'm not. But I mean, the current economic challenges are consumer confidence, right? And arguably, consumer confidence was not an issue in those 3 previous rallies, which responded to stimulus like it was a question of money, effectively. And now, arguably, you have the toolkit of the government. They're throwing everything at this almost, but it's something that they've not, they haven't encountered before. And so far, we've heard a lot from policymakers. What we don't have a lot of information on is how the consumer will respond. And I'm wondering, what gives you the confidence that you think they will?
Well, really great question. And David, I would argue that actually they have. They have in the past experienced, you know, instances when consumer confidence was at a low and then the policy drivers were actually deployed to stimulate that. And that is why we think that, you know, from experience and from a historical perspective, there will be the possibility of this being effective. And you know what? During COVID and even after the reopening of China post-COVID pandemic, there have been experiments of essentially, you know, providing cash vouchers and spending vouchers for certain cities only. And it wasn't nationwide, but it was for certain cities. And they've actually discovered that the multiples in terms of the spending, if you provide like a $1 into the pockets of consumers, that they can actually give a multiple of about 3 times. So that was an experiment that was done you know, post-pandemic, and it has shown its effectiveness. So at this point in time, I agree that consumer confidence is probably at multi-low, and you know, it takes time, right? So over the past 3 years, you know, that the consumer confidence have been really on a decline, and it hasn't really been showing signs of any recovery. So it will take time for that to recover as well. So we probably will see that, you know, as one of the most important lever that the Ministry of Finance will be able to pull at this point in time.
In the meantime, though, until we get that to feed into the economy, this is a very liquidity-driven market now. It's back in some ways, Christy. How are you positioning? It looks like, you know, if the stage has been set for some sort of mega rally, what's the investment advice now?
Well, for value investors, you definitely are in the right positions because you would have been well positioned for this. And I think even if you look at the global environment, the Fed's cutting rates, and you know, we're reaching the last stretch of the U.S. elections. So all the backdrop, even that, I mean, if you look at just where, you know, performance of emerging markets or equities in APAC, after the Fed cut rates, you know, that, and you're looking at potentially on average, you know, around 70% of a rally in Chinese equities, 12 months from the Fed's first rate cut. So I think, you know, as not just value investors, but anyone looking into, you know, just China, and also because of the policy pivot that's happening, there are many ways to position this. You can really increase exposure either via Hong Kong or increasingly, you know, via even some of the passive ETFs.
Yeah, I mean, Christy, if you're right, this could go up 100%. It really doesn't matter what vehicle you're on, right? Where does this leave other markets like the U.S., which touch a record high? Markets like India that have done well on the back of maybe because China hadn't done well. Just your thoughts on everything ex-China at this point, then.
Yes, so, well, perhaps from a portfolio management perspective, this could well lead to some of these allocations away from some of these high performers and then, you know, back into China. But I would say that at this point in time, a lot of you know, the global backdrop is just is just showing signs that you know, increasingly for equities markets, there's still some room to grow and you know, increase, and the rallies have legs, although there's going to be a lot of volatility that investors have to be mindful of. So we would always suggest, you know, getting out of cash, but going into quality, going into essentially, you know, probably growth, and certain sectors that will actually look to benefit, be it, you know, consumer discretionary, financials, or energy, that could look to benefit from the more constructive global backdrop.
It seems like you're leaning more towards equities, towards risk assets, Christy. How should I look at treasuries and bonds right now? We've seen this treasury curve basically shifted around that 4% level. Do you think we're back to fair levels after this sharp sell-off?
Well, for the long term, you know, there is still some scope for the concerns that, you know, how is the U.S. economy slowing, the extent of the slowdown, and whether or not inflation will pick up. So there's a lot more uncertainties in the longer term tenors that we would probably want to be cautious of. And potentially, 10-year around 4.1, 4.15, that could be a great entry level. But in the meantime, I think to look at, to tide through some of the volatility that will present itself in the near term, look at short to medium term intermediary treasuries. Those are actually good, I think, positions to hedge against the volatility.